What is going on, guys? Welcome back to the MG YouTube channel. I'm your host, Malachi Grubb, CEO of Lead Automation, Lead Properties, and investor in Tesla. So I want to talk to you guys about some things that we have going on, like financially, and what we're trying to do with some of the next properties. Also, just kind of let me know if there's any particular videos that you'd like for me to cover. Obviously, I'm doing like quite a bit of different business things. So I don't make a lot of videos on, what we're doing business-wise, but it's really why I wanted to make this channel, is kind of take you guys through some of the things that we're experiencing in business and things that we can kind of transfer to you guys and be able to learn to be able to create your own wealth and whatnot. But currently, well, if you don't already know, over the past 6 months we bought 6 properties, and it was one of our biggest investment phases that we went through. A few of those properties were somewhat move-in ready. Pretty much every one of those properties got something done to it. If the bare minimum is like painting almost the entire property. But a lot of times we do that because one, we don't like the colors. Two, I don't know, a lot of people don't do a good job when it comes to painting and whatnot. And on top of that, you can take something that just hasn't been painted, paint it, and it looks so much fresher and whatnot. So that's something we always go through and do. Some of the other properties were like much bigger renovations, everything from bathroom remodels to laying floors throughout the entire property, which pretty much majority of our properties we do floors and paint throughout the entire property, unless we just happen to have really good floors in one of the areas. It's just like one of the cheaper material and labor things you can do to a property that just adds a lot of value and a lot of like cosmetic appeal to the property. And so that's one of the reasons why we do that. Now, like the next thing that we're getting into is we're in the process of doing a cash out refi on one of the properties that we did more significant renovations on. And the thing that we're running into is basically our credit scores have dropped pretty significantly. And that's really one of the biggest reasons why I wanted to make this video today, is to discuss like credit and how credit works, and things to keep in mind, and not just credit, but also some of the financing between like different types of like credit cards and whatnot. So when it comes to credit cards or credit in general, or how do I say it, lines of credit, whether it be like actual credit lines, credit cards, and this is a big one that we're going to discuss today, is commercial credit cards versus personal credit cards, and what are the pros and cons of using each one of those. And again, that's one of the main things that I want to showcase today, because it's the reason why we're in the issue that we're in. And essentially, we're buying these properties, and then we're essentially cash flowing renovations through the credit cards. Okay, whether it be Home Depot credit cards, Menards credit cards, or like our generalized like Chase credit cards. But generally, you can actually get approval for a lot more credit at like store locations. So like a Menards or a Home Depot, they will generally give you a lot more credit than what you can get at like, say, for instance, Chase. Okay, so when you're utilizing a personal credit card, which is where a lot of people start, right? They utilize personal credit, and it takes some time to be able to start being able to utilize business credit. If you have really strong personal credit, generally you can go ahead and open up a business credit card line. But the issue is, a lot of times that line is going to be really small at first until you like cash flow through that card, and or just hold it for a period of time. I think they like to see both. They like to see you hold it for a long period of time, and they also want to see you cash flow through it. The more that you cash flow through it, they'll say, okay, this person's spending and repaying, spending and repaying, spending and repaying. Let's give them more of a limit. I think that's almost more important than the time aspect of things. If they just see you constantly spending money and paying it off, spending money, paying it off, they're keeping track of the cash flow that flows through that card. And so I also think that you should try to cash flow through cards as much as you can. For example, I just made a payment to something. Let's just say, for instance, like our like the water utility bills. Okay, so instead of me paying the water utility bills directly out of our bank account, we pay the water utility bills out of our credit card, and then we pay off the credit card with the bank account. One, it creates a buffer between your bank account and whoever you're paying, which is good because credit cards have insurance on them for like things like fraud if somebody steals money out of them, and you have that in your bank as well. But generally, a credit card just automatically refunds it, and it's like you get your refund in a couple of days. Where a bank account, there's like an investigation that has to be done. It can take 30, 60 days before you can get your money back if somebody takes your money out of your thing. But the big thing is the cash flow. That's the biggest reason why we're doing it, and the buffer thing, because that's also just like part of our process. The way that we do things, anything and everything we can cash flow through a credit card, we'll cash flow through a credit card and then pay the credit card off. So that way it isolates the bank account from the outside world, basically. Only the credit card is actually touching the outside world. No, now that's not the case because there's a lot of things where either you can't pay with a credit card or they won't let you do auto pay with the credit card. And auto pay to us is more important than having than utilizing the credit card because we just want to automate things and keep these running smoothly. Now, whenever it comes to utilizing your personal credit card for these renovations or whatever it may be, the thing that will happen is that whenever you use the full credit limit of a credit card, your credit utilization will be impacted, which will drop your credit score. And it can drop your credit score pretty significantly. Now, for me personally, I have like quite a bit of personal credit, and I also have quite a bit of business credit now. I think it's getting close to where we finally have an equal amount of business credit as we have personal credit. And that's something that we've been working towards for a few years. And this is on the Elite Property side of things. This is not the Elite Automation side of things. So for Elite Properties, we finally have kind of like built up and just kind of, either added a credit card and then slowly have increase the limit of that credit card. Because again, most times they're going to give you a credit limit. That credit limit's not very much, so you have to like over time keep asking for credit limit increases. And seldomly, the bank will automatically just give you a credit limit increase. Like if it's a credit card that allows you to go over limit, sometimes after you go over limit, it will then open that credit to be more than what it was, which is good. And that'll happen on the personal and the business side as well. But when you utilize a personal credit card, your utilization will go up, and then your credit score could drop significantly. And to showcase how significantly it impacts, prior to us doing all these property renovations, we had pretty much like all of our debts paid off, and my credit score was like at like 800, and I think Jenna's credit score was at like 750 or something like that. Right? We both had really, really good credit scores. Okay. We went through and we used both business and personal credit cards, but just through like kind of maxing out all of our personal credit cards. And when I say personal credit cards, I'm primarily talking about like these store accounts like Best Buy, Home Depot, PayPal. These are some of the ones that we use. I don't actually have much credit card debt that I personally use. I don't personally use credit card debt for personal things, almost never. There are some instances, and I can maybe explain that in another video or something like that, but it's very, very seldom. Again, it's almost never. If it's something I want personally, then I'll use my personal money to do that, versus putting something on credit. Now, I do use personal credit cards in business a lot. And again, the number one issue you're going to run into, you utilize your credit on your credit cards, and your credit utilization is going to go to, let's say, 100%. So our scores went from like 800 to like drop to like high 500s, which is like basically a trash credit score for the most part. You can't really get hardly any loans. Most loans are qualifying at like, there's like a 620 threshold, I believe, and then there's like a 680 threshold. And so like, if you're above 680, you can pretty much get a loan for just about whatever, as long as you have the financials to back it up. Um, now, which is going to basically look at your debt to income ratio to to qualify you for the loan or whatnot. Uh, Now that's different for different loan products. Like for the properties, we use a lot of DSCR loans, which is a debt service coverage ratio loan. Basically, means it looks at the property value only, and it doesn't look at your personal finances. It doesn't look at the business finances really. It just makes sure that you have enough to close on the house, 6 months buffer to be able to pay for the house, and and that's all pretty much all it looks at. And the property itself will cash flow. It'll rent out for more than what your mortgage payment is, plus some margin of like 25% or something like that. Um, so if the credit score is being impacted so much by using personal credit, then why would we use a personal credit card? Again, there's two major reasons for using a personal credit card. There's three major reasons for utilizing a personal credit card. One is because it's your only option, right? It's either your only option or you've capped out your business credit cards, and so you need to move to personal credit cards, right? Now, I'm not going to tell you should do one versus the other. We're going to kind of get into that, and you kind of got to make the decision on your own on whether you should use a personal or business credit card, because I think that both are still very good and have very good use cases. The second thing is that a lot of these store cards will offer 0% interest on like either a certain dollar amount or certain product type. Like, let's say for instance, like Best Buy might say like 24 months, 0% interest on appliances. Okay, so you could either run that through your personal credit card and pay 0% for 24 months, or you could pay like 24 to 27% interest on your commercial card, and obviously you're paying interest on that. So one, you're getting 0% debt versus not 0% debt. So when it comes to business, there's no such thing as 0% debt on the business side. Whereas on the personal credit card side, there's a ton of 0% options. I mean, literally almost every single store has a 0% interest option. Again, whether it's the appliance where it's saying like these appliances are at 24 months, or whether it's a TV, washer, dryer, and then like places like Home Depot and stuff like that might run promotions where it's more of a special on like flooring. They'll say this month only or whatever. Flooring is 0% interest for blah 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 months. Or Home Depot pretty regularly has one where it's like if you spend more than like $700 or $1,500 or like $3,000, any of these dollar amounts on a singular transaction, it'll qualify for either 6 months, 12 months, 18 months, or 24 months deferred interest. Okay. Now, don't get me wrong; it's deferred interest, so it's not completely interest free. You have to pay off that debt before that debt is due, before that 24 months or 18 months or whatever the term is of that 0% interest debt. You do have to pay that off, or else you incur all the interest. And in that scenario, if you can't pay that debt off before that debt is due, it's not worth doing whatsoever. Also, a quick little hack is if there's a $2,000 threshold, one thing that you can do to kind of like insulate yourself, let's say for instance I'm buying $10,000 in flooring, just to give an example. You can break that flooring order up into 5 different payments. So literally buy that flooring 5 separate times under 5 separate transactions. So that way it's 2,000, 2,000, 2,000, 2,000, right? 5 times. So that way your chunks are smaller. So if for some reason you can't pay off that debt in the time that it needs to be paid off, you can pay down portions of it and not get charged for interest on that amount. So like let's say for instance, we were able to pay $8,000 of that $10,000. Well, since we chunked those into $2,000 chunks, now $8,000 of that does not get interest paid on it. And let's say, for instance, that $2,000, last $2,000 expires. Now we don't. Now we have to pay interest only on that $2,000 and not the full $10,000, which would make that whole entire transaction worthless if we had to then pay interest on it. And we almost never will pay interest on those 0% APR. We always pay them off on time. Either we're cash flowing too heavy, so it means we just have to pay off the card to buy like the next transaction of things that we need, whether it's appliances for the next property or whatever that may be. The only time it ever happens is where we pay interest is when really two things happen. One, I just forget about it because I have other financial things that I'm worrying about, and I forget to go in and check the deferred interest. But it mainly happens whenever I think, a lot of times I'll think like Home Depot's always running that 24-month deferred interest if you spend like the $2,000, but it's not running always. Sometimes it's running automatically, and maybe it's running for 3 months out of the year or 6 months out of the year. And then sometimes they do this little trick where they send out a coupon, basically, with a coupon code in it, and you have to apply that coupon code to the purchase. Now, if you don't apply that coupon code to the purchase when you purchase, a lot of times they'll allow you to call and add that coupon code in after you purchase. And sometimes you don't even have to have the coupon code. You can just call and say, hey, look, I thought this was on the deferred interest thing. I seen it on a sign somewhere, and I thought you guys were running it, and this purchase did not go on a deferred interest for 24 months. Maybe it went on deferred interest for 6 months only, which has happened. And a lot of times they'll say, oh yeah, we were running the promotion during that time. We'll adjust it for you and we'll fix it. But there's been times where I've called and they said, no, actually we weren't running that deferred interest at that time. So this one only qualifies for a 6 months deferred interest, which sucks. So now you thought you was going to turn this into a 24-month deferred interest, and you didn't turn it into a 24-month deferred interest. You only turned it into a 6-month deferred interest, which a lot of times may not be enough time to pay off that amount if it's a $10,000 purchase that you made. So that's something to keep in mind. But again, chunking them down into smaller things is the way to go. The next big reason why you'd want to use a personal credit card over a commercial credit card is the minimum monthly payment. Okay? Personal credit cards, if I'm not mistaken, and this is a rough proximity, it's not going to be exact. Personal credit cards are roughly 1% of what is owed on the card. So if I owe $10,000 on the card, my minimum monthly payment is $100. Okay? I like that a lot because it doesn't mess with my cash flow. And then I'll go ahead and go into the business commercial credit card side of things, so that way you get an understanding of this cash flow side of things. That same $10,000 owed on a commercial credit card will a lot of times be 0.8% of what is owed. So if I owe $10,000, my minimum monthly payment on that is $800, okay? Which is 8 times the amount of what it would be on a personal credit card. And that, again, is one of the other big reasons on why you might want to use a personal credit card versus the commercial credit card. Because let's just say, for instance, you're doing your first property investment, right? And you bought the property, you're going to cash flow all the renovations with the credit card. And let's say, for instance, you're doing a long-term rental property. And on that long-term rental property, let's say, for instance, you're going to have like $1,000 a month mortgage, and you're going to rent it out for $1,200 a month. So all your expenses for the property is $1,000. Let's just include everything into that $1,000, and you're going to rent it out for the $1,200. okay, you're cash flowing $200 a month in profit for that property every month, okay? You had to do $10,000 in renovations, okay? I'm not including the credit card payment that you need to make in that property, okay? So now that same scenario of spending $10,000, you would have a $100 monthly payment, aka it'd cost you $1,100 a month now to operate your property, and you're making $1,200, so that's $100 in profit a month that you're making. Under a commercial credit card, now you're losing $600 because your monthly expense is now $1,800 if you're utilizing that property to pay off that credit card. Your minimum monthly payment on that property is $1,800. You're renting it out for $1,200. You're losing $600 a month to own this property in the short term while you're paying off that credit card. And so that right there is a huge deal, right? Because if like your primary thing is I need to cash flow positive or I want to cash flow positive, theoretically you can continue to do that infinitely across properties if you're able to cash flow positive with the personal credit card. Now there's caveats to that, like the first things that I mentioned about the impact on the credit score. Okay, so the impact on the credit score may be a reason why you definitely don't want to use that personal credit card. But again, if you're not planning on investing into another property for another year, then let that debt sit there. Let that debt sit there and pay that debt down. Any extra you can pay that debt down. Maybe you're not profitable. Maybe you take that extra $100 a month that you're making and you pay extra on that credit card, right, to pay down the actual debt of that credit card. But now you're cash flow neutral. You're not cash flow negative. Whereas again, on this other one, you're cash flow negative. You got to find out where you're going to come up with that extra $600 a month to pay off that commercial credit card that your property is not making for you. Now, hopefully your margins would be better and it would still be enough to cover that. But let's say, for instance, even if you were making $1,800 a month in rental income, now you're at neutral break even every single month with the commercial credit card versus like having that'd be $700 a month profit on the personal credit card. And you can take that $700 a month profit and boom, pay it towards the credit card. And at $700 a month, 0% interest, you're going to have all your debt paid down in like 12 months anyway. And on a 24-month deferred interest, you'll be able to pay off that debt in like 18 months. Now you basically had no extra cash out of pocket, which is the biggest thing when it comes to property investments. And I already knew this, but this was definitely a mistake that we made whenever we bought these. Past 6 properties, is we took cash and moved it into properties, and we really didn't take into consideration going into our next future properties, aka meaning we used a lot of cash to get into these properties, but now our cash is locked up in these properties. Now we don't have the next chunk of cash to buy the next property. Okay, and a way around that is to do a cash out refi. Okay, the issue is like I said, some of the properties we bought like pretty much move in ready, and we didn't do much to them. So just by going in and painting the property, we're not going to get enough money back out of that property for it to be worth it to do a cash out refi. Even if somehow it came in and appraised for $10,000-$20,000 more than we purchased the property for, by the time we go through closing and lending expenses, now we're only going to get maybe $10,000 back out of that property, which is, in my opinion, not worth it. It's not worth spending $10,000 in like closing fees and lending fees to get back $10,000 and then have $20,000 more in debt on that property. To me, it's just not worth it. It's not a good long-term play. You're just got to kind of keep sinking yourself and spending money on debt, spending money to acquire debt to receive a small amount of cash to go into the next one. For me, I want to see probably $40,000 plus. I want to see $40,000 plus in a refi in order for me to want to do a refi, unless I'm getting a significantly lower interest rate. For example, the building that we're sitting in right now, this is like one of the very first. Well, it's the only commercial building that we own, but at that point in time, like I didn't know about DSCR loans, and I didn't know about the different loan options that were out there and everything like that. And so we were actually going to pull extra money for Elite Automation, and we were going to wrap this building up as collateral for the additional money that we was going to ask for. And then we decided we didn't need the extra money from the bank. So then, again, we didn't take that extra money. We didn't take that extra money from the bank. And so this building was done under an SBA loan, which I don't think is the best way to go about doing a property. I think if you're just doing a property solely, you should do a property loan, because we can get this property at like 7.5% interest right now, and rates are really high. So, so I might cash out refi on this property, and we're probably only going to be able to pull out like somewhere between like $10,000 to $40,000. No, not 10, 20 to $40,000 cash. But I'm actually not cash out refining for the cash. I'm cash out refining for the lower interest amount, which is also going to, we're gonna be able to pull out that cash and then be able to lower our monthly payment on this building by like $500 a month. So that's a big reason for doing that, getting cash in hand, and we're gonna lower the monthly payment on this property. That was a bit of a side tangent. Maybe that should have been a topic for another video, but I like to share these things as I'm thinking about them. Now going back into the like utilizing the personal credit versus the commercial credit card. The biggest issue with using the personal credit card, from my perspective, is 101% the impact on your credit score. The issue that we've now ran into is because our credit scores dropped so much, we're doing a cash out refi on one of our properties, and we're actually held up due to our credit score. Now we've had to make, what was it? 10, 20. We paid $20,000 towards personal debts to pay down those debts to get our credit score back up where it needs to be, so we can cash out refi on this property. And I think the property that we're cash out refiing on, we're going to pull like, it's $68K in value by the time we do closing and everything like that. We're going to probably be looking at like somewhere between $55,000 and $60,000 cash in hand after we do that refi. And we're held up basically because of our personal credit score. Now, not only did we have to take $10,000-$20,000 cash out of our hand and pay down those debts, but we also have to wait like a month for it to report to the credit bureau, that our credit utilization is not up, and it just showcased like the impact of that. We paid $6,000 of the debt to a credit card that was reporting, because every credit card reports at a different time, which is actually something very important to know. Because technically you could like move some cash around to not pay off as much debt, but I wouldn't get into that; it could get risky. But essentially, we had one credit card reporting earlier in the month, and then another credit card that was reporting later in the month. But we went ahead and paid that one that was reporting earlier first, and with that $6,000 that we paid, it bumped our credit from like, well, from mine went from like the high 500s to like 630 something, right? So I'm almost at that 680 where I need to be to do this refi. And so this additional $10,000 that we're going to pay should get us over that credit threshold to be able to get this loan. Another thing to keep in mind too is with your credit, not only to qualify for the loan, but the higher your credit score is, the better loan terms that you'll get, the better interest rates that you'll get. So I think it caps out around like 720 or something like that. So if you have higher than 720, you're going to generally get like the best rates possible on a loan, which could drop you like 2%. You can go from like 7% to like a 5% loan by having like a 720 credit score. So it does have impact on us if we're like acquiring a bunch more properties. And like right now we're trying to pause on properties because We have other investment stuff that going on. Like me specifically, I'm planning to put a lot of money into the stock market. Right now we have this war stuff going on, and the market's basically plummeted. If you don't already know, like one of my big investment is Tesla and everything AI related and energy related. New energy, not old energy technologies, new energy technologies. But um, but yeah, I see a lot bigger opportunity in the stock market side of things than I do the property side of things at this very moment. At least from right at this moment to like the next 6 months, I think that there's just going to be a lot of opportunity um, for the stock market to shoot up, right? So why'd I go off on that side tangent? Oh, I don't plan on buying properties for the next like 6 months or so. Now this is a problem because I always want to buy properties. I'm literally like talking to people and like doing placing like offers on properties, not formal offers, but just kind of like getting fillers out there, like, hey, what do you want for this property? Hey, blah blah, blah. Right? A little bit of like not light negotiation, but just have some fillers out there, trying to see like what's out there, see if there's a good deal, see if somebody maybe want to present a good deal to me. So it's not just asking them like, hey, what do you want for this, and they'll give you a number and you're like, oh dude, we gotta jump on that. But that's one of my issues too, is I'll find a good deal and I'll jump on that, and it will be a good deal. The issue is I have this other deal over here, aka the stock market, that's a better deal for me right now, a better investment for me right at this very moment. Um, and because if you don't know, like in the past, which I haven't made a video on this in a long time, one thing that we did is we did I call it rinse and repeat. I took a bunch of stock market money and put it into properties, and that's part of the way we was able to buy these 6 properties. Now we're pulling money back out of the properties and putting it back into the stock market, and we'll probably do that same thing. We have a really good stock market return again this year. I'm going to do the same thing. I'm going to pull cash out of the stock market. I'm going to put it into properties. And I'm going to keep doing this rinse, repeat cycle. In the future, though, one thing I'm going to do is buy more distressed properties. I'm going to ensure that our properties are more distressed and they're more lendable as well. Matter of fact, subscribe to the channel. I'm going to make a video after I make this video talking about refining some properties and some of the things that I learned on the past 6 properties and like what deals were good deals and not good deals. Not good deals in the sense of for a cash out refi purposes. I think everything that we bought was a pretty good deal or under market value. Going back to just the credit cards. Again, the biggest thing I don't like about the commercial credit card is the big monthly payment. I don't really like the interest either. I don't like paying interest if I don't have to. But I especially do not like the large monthly payment. For perspective, giving you the numbers, we have like probably $50,000 in commercial credit card debt. I think that's somewhat. No, I think it's closer to 30,000. Sorry, 30,000 in personal or in commercial credit card debt. I think we have like another 30 or 40 in personal credit card debt. Again, for the properties. The commercial credit card debt is costing us almost $5,000 a month right now, roughly, give or take. I mean, it's actually closer to probably like $3,000 a month. It feels like $5,000 a month, but because when you're seeing like Home Depot, it just came out today actually, and I sent it to Jenna because I'm explaining these things to her, like so she understands these things as well. But our Home Depot credit card payment this month was $650, and then the one Menards credit card is like $10,000, so it's gonna be like $800. The other one is like a $20,000 credit card, so it's gonna be I think it was $1,700 is what it was actually, and so $1,700. Yeah, I mean we're over $1,700. We're about like $3,000 in per month in debt for the commercial credit cards. The positive side is the commercial credit cards will pay down quicker. So since your minimum monthly payment is like 0.8%, About 0.5 of that is going towards the actual principal pay down. So about like $200. Well, it completely depends on how much you owe on the card, but like $200 to $400 with these dollar amounts is going towards interest, and then the rest is going towards the actual principal. So it does pay it down a little bit quicker. And if you pay like a chunk towards it, like if you pay an extra $1,000, the next month, you're going to pay what, $80 less per month. Is that right? Yeah, about $80 less per month. If you pay $1,000 on the commercial credit card, next month's payment will be like roughly $80 less than what it was the month before. So it does tick down, and every single month it will trickle down lower, lower, and lower. But the big thing that I want to showcase with this is like you can get yourself in trouble with debt by just like literally the commercial credit card itself causing the problem, being the reason why you're in the negative cash flow. Again, I use that example with the singular property and cash flowing that. It can happen at any scale, right? If we get to a point where we have $200,000 in commercial credit cards, there's a plausibility that could land us in trouble one day where, all the properties are not cash flowing enough to then pay down the renovation debt. Now, I don't see that happening in the future unless we are able to reach a point of scale where we can just keep acquiring so many properties so quick. The thing is like we just bought one of the biggest chunks of properties that we bought, and unless the stock market does extremely good this year, we're probably not going to be able to buy that many properties this year. If any, this is actually supposed to be a pause year where we basically buy no properties this year. We just keep like adding more value to the current properties that we have, paying down debt. Like that's the focus this year. And sometimes that's just what you have to do in business is have that focus. Now, I really don't want to sit idle for an entire year and not buy more properties. Again, if the stock market does really well, we get that money put into the stock market. The stock market does really well, we're going to deploy it to more properties, probably this year. And I'm trying to thought. But the grand scheme of things is like we want to pay down debt so we don't have that monthly $3,000 a month or whatever it is paying towards like credit cards, and it gives us a clean slate. So as soon as we're ready to invest in a property, we can go into a property that needs heavy renovations, like $30,000, and that's not even that heavy of renovations, but like it could be we could buy the property for like $20,000 and put $30,000 in it. So when I say heavy, it's heavy for like the total purchase of the property. We could put in we can put in that chunk and not even worry about maxing out our commercial credit cards, right? As we were maxing out our personal credit cards, as we were maxing out our commercial credit cards, all the credit cards actually, doing these 6 properties, we would then have to take cash flow money and pay down the credit cards. So like Menards would get maxed out. I'd have to pay like $5,000 on the Menards card just so I could go and buy our next lump of materials. And this is actually another little bonus tip here. It's to cash flow through the credit card. As I mentioned before in this video, it doesn't work out on like Menards cards like when you're not doing renovations, okay? It doesn't work on Home Depot credit cards when you're not doing renovations. But what I mean by cash flowing through cards, let's just say I'll give you a perfect example. I actually just discussed this with Jenna. We purchased a lot of our cleaning supplies and stuff like that through Amazon. We just have Amazon them, have them ordered, shipped directly to the house. That way Jenna just has them with her or whatever. So I said, hey, like all these consumable expenses that we have at our properties, instead of us running those through Amazon, let's run those through Menards, because Menards has like a lot of like cleaning supplies. I mean, Home Depot has some of that stuff too, but Menards is even better at having like more household supplies like toilet paper, paper towels. Those of you who don't know, we do like Airbnbs and stuff. So these are things we have to replenish, dish soap, things like that. So it may not be a huge amount, but we have 10 properties now. I think 9 of them are Airbnbs. Maybe we have 11 properties. I have to go look. Okay. Pretty positive 9 of them are Airbnbs right now. And I can pull it up right now, actually. So let's just say, for instance, with all of those properties, I'm just gonna put a number to it. We're spending $500 in cleaning supplies and trash bags and soaps and dish detergent, all these things, right? All these things. We're spending $500 a month on that, and I'm just using a random number. I don't know what the number is off the top of my head. As I was telling you before, the one commercial card is sitting at like $800 a month in a minimum monthly payment. Well, instead of buying through Amazon with Chase, our Chase credit card, and cash flowing through Chase, because Chase already has enough cash flow. We don't have to worry about our Chase minimum payment because it's paying water bills and other different types of utilities and stuff like that, so that every month we just cash flow through that card. AKA the minimum monthly payment doesn't matter because money goes out, money goes in, money goes out, money goes in. That's cash flow, okay? Menards is not cash flowing when we're not doing renovations, okay? So now we can take that $500 a month and pay that towards the Menards card, reducing our total minimum monthly payment. But let's say, for instance, I'll use an even easier example. Let's just say, for instance, our cleaning materials expenses was $800 a month, okay? And we have an $800 a month minimum payment. If we cash flow our cleaning expenses and cleaning materials through the Menards card at $800 a month, now we essentially don't have a minimum monthly payment on one of our Menards cards. So essentially, we were able to cash flow that, and we were able to eliminate that that credit card's minimum monthly payment. So now I won't consider it a minimum monthly liability because, again, we don't have a minimum monthly payment anymore. We're cash flowing through it so that there's now not a minimum monthly payment. Now, that only works if you need to spend that amount of money. If you're already going to spend that amount of money with another credit card or something like that, you might as well do it so that you can cash flow, because on the grand scheme of things, when you're operating a business, when it comes to cash flow, you have to cover all of your minimums, right? I have to cover my minimum monthly cleaning expenses, and I have to cover my minimum Home Depot or minimum Menards payment, right? No matter what. And so in that scenario, I'm taking these two independent debts of $1,600 a month, and I'm overlaying them on top of each other. So now it becomes only one $800 a month debt. The caveat to that, if you're going to do that, it will remove your minimum monthly payment, but your card will not ever pay down, and you'll always be paying interest on that $10,000. So that's the caveat to that. But if it gives you the ability to pay an extra $200 a month, whatever amount a month, and on top of that, if you can make that, if you make that payment, let's say, for instance, on the 1st of the month, but you don't actually need to buy your cleaning expenses till the 20th of the month, now you have 21 days out of the month that you're not paying interest on that $800 because you've cash flowed the money in, but you haven't cash flowed the money out. And that's a very small, minuscule amount of money to a degree. I mean, it might save you $20 a month or $30 or $50 a month. But those type of practices, whenever you grow and you're doing a lot more numbers, like when we get to a point where we have like hundreds of properties, things like that matter. Things like our companies like, say, for like Robinhood stock market investing in banks, they make money by holding your money. Literally, they're making money by holding your money. That's how they make money. So by you acting like a bank, and you're the opposite of a bank and not allowing them to hold your money, you don't let them hold as much money as possible by paying that payment on the 1st, and you're not using the debt until the 20th. That removes that amount of time that the bank is taking away that debt. Now, if I give you that same number and I said, okay, well, now it's currently $20 a month. Well, if you scale that across 100 properties, that number might turn into $2,000 a month in interest that you're saving by doing something like that. And then on top of that, too, if any extra $100, $200, $300 payment that you're making towards that Menards card is all principal payment. Now you're actually paying down that debt more aggressively. So if I was to cash flow like I'm talking about and still make that $1,600 a month payment towards Menards, I'm actually going to pay down that debt by like $800 a month versus the $600 a month. Why 800 versus 600? Because the minimum monthly payment is $800, 600 of it's principal, 200 of it is interest, right? So now you're covering that interest amount, and so that 200 extra dollars of the 800 is going to actually go towards the principal pay down of that debt. And so you're actually saving another $200 a month. So you're saving that $20 for like the 20-day gap that I was talking about, and then you're saving $200 a month if you're, again, continuing to pay that additional minimum amount to that Menards card. Now you're saving an extra $200 a month that you're paying towards that card. And when you're talking about $800 a month payment, saving $200 a month is what, 25%? So you're paying an extra 25% towards the card every single month. So hopefully this was valuable to you guys. If you have any more questions revolving around the commercial credit cards and personal credit cards, let me know down in the comments below. Subscribe for more content like this. And also, the one of the big things I can't leave this one out. Commercial credit cards don't impact your credit score. Most of them. Make sure, check, verify, all that good stuff. But 99.9% of commercial credit cards do not impact your credit score, and that's the number one benefit of using a commercial credit card versus using a personal credit card. In my opinion, it's the only benefit. There's literally no other benefit besides that alone. And me and Jenna have even been doing some playing around. Another last bonus tip before I go. Have been doing some playing around where she has her personal credit cards, I have my personal credit cards, and she might be the guarantor on a loan while my credit's down because I use my credit cards for these renovations. And then we'll flip and do the other way around. Then Jenna will let her credit score get drugged down by using her credit cards. We'll pay down my credit cards and also deferring interest, right? Paying off our deferred interest things as they start to expire. And then my credit will become good. I will go for the loan for the property. And so we'll do that wish-washing type of thing too. At some point in time, maybe we'll just cash flow so heavy that I anticipate we'll cash flow so heavy at some point in time that we'll barely need the credit cards to pay for the renovations. Essentially, at some point, we're going to be to a point where basically we're cash flowing heavy enough where we still cash flow through like the Menards card, but then we're like just paying it off every month, right? We're not to that phase yet, again, because this is one of the biggest investments that we've ever went through. Again, 6 properties in 6 months, and then all the renovation expenses along with it. Again, some of them were small, just paint things, and other ones were like redoing all the floors, painting, trim, new doors, new bathrooms, like all different types of things, right? All new hardwares on cabinetries, all new appliances. Dude, that's an expensive one. Since we do the Airbnb dealio, almost every property that we do is like $15,000 in appliances. That includes like TVs, washers, dryers, refrigerators, all the things that you normally have in a house. But yeah, huge money suck. That's like one of the big things that we have to cash flow through whenever we're doing our properties, and it's just due to our type of investment with the properties and stuff like that. But yeah, let me know if this is valuable, guys, and I'll catch you in the next one. Subscribe, and peace out.